Well, let's bring in our cost of living panel. Joining me, the Chief Economic Advisor at Judo Bank, Warren Hogan, and the unconventional economist at MacroBusiness, Leith van Onselen. Welcome to you both. Look, big day today, the first rate decision of the year. The RBA kept cash rates on hold at 4.35%, and Governor Michelle Bullock warned that inflation was still too high. She said the rate rises in the future could go either way. Everything was still on the table. Leith, what did you take from her press conference? Because this is now part of the new regime, the new reforms implemented by the Treasurer, that we get to understand more about the RBA's thinking behind rate decisions.
Yeah, look, honestly, I think the decision played out pretty much as everyone expected. I mean, inflation's falling. That's pretty clear. The RBA noted that. They still noted that it's too high, so they're giving themselves some wiggle room. And the statement today was a little bit more dovish than the previous one, which means that it's a little bit less likely to raise rates. And I think it's taken the right approach. Basically, what the RBA said today was that they're going to wait for the data to see how it pans out. And if it continues to weaken, they potentially might cut. They didn't say that explicitly, but that's the implication. At the same time, if it ends up being firmer, well, then they could raise rates again. So they're pretty much sitting on the fence, which I think is the right approach and the sensible thing to do.
Warren, there are still areas of very high inflation, double digits, rents being one of them. What are the areas of concern?
Yeah, I think that's just the domestic service inflation that they're worried about. Most of the fall in inflation we've seen in the past year has been essentially global in nature. That is, it's all the stuff we import, goods price inflation. So that's great. We've got those prices coming down, but everything from insurance to rents to any other domestic service is still rising at a much higher rate than I'd like to see. And that's, of course, why they're giving themselves, as Leith said, some wiggle room. I don't think they'll necessarily have to raise rates again, but I think the message from today to all and sundry across the community is don't expect rate cuts anytime soon.
They're still expecting the target band of 2 to 3% by 2025, Leith, or do you think that's going to be pushed back to 2026?
Yeah, look, the RBA did lower their inflation forecast from the previous statement. So at the end of the year, they were saying it was going to be about 3.5. Now it's 3.2 at the end of the year. I honestly think that it's going to fall quicker than what people think. We've got, basically inflation falling across the globe, mostly driven by goods, but also the whole energy price inflation that we had, which has been one of the drivers, is now coming off as well. So I'm still tipping rate cuts in the second half of the year. Maybe we can catch up in 6 months' time or 12 months' time to see if I was right. Well,
let's hope you are, but don't worry if you're wrong. I'm not going to play your quotes back at you on the show like we would do to politicians. Warren, we are seeing that cost of living is still biting. We know that there's been a big issue in the construction industry when it comes to insolvency. Now we're seeing retail and hospitality also folding at a faster rate. So, how do you think these different economic factors are playing out?
I think this is a really important element of the economic landscape right now. We've seen the construction industry go through their problems. That's unique to the construction industry because of what happened in the pandemic with fixed price contracts. But we are actually quite vulnerable to a wave of insolvencies. And the reason is insolvency levels have been low, not just through the pandemic, but in the 5 years leading up to it. So there's a lot of what some economists call zombie firms. These are weak firms that, as interest rates go up, as the competitive conditions in the market tighten, they just don't survive. And I think this is, as you referred to now, broadening to hospitality, retail. It's actually happening across all industries. And this is one of the key downside risks to the economy, is if we see a real surge in insolvencies over the next 12 months, that's going to displace a lot of people from jobs. And although there is a lot of demand for labour out there, you don't just go from one job or one industry to another seamlessly. So I think this is something to watch very closely.
Yeah, I also think there is a bit of a contradiction. The media celebrating wins like today, and yet people are still doing it very tough at the minute. Now, just finally, some companies are starting to have mandates on office attendance, but there's warnings that this would lead to lower staff satisfaction. People now want the flexible working hours, this according to an analysis of around 500 firms. Leith, it's very difficult to navigate this new post-COVID climate when you want your workers to be satisfied, but a lot of bosses also want them to do some face time in the office, concerns around productivity.
Yeah, that's right. Look, it's really too early to tell whether or not the whole work from home phenomenon is detrimental to productivity. We probably won't know for a few more years once there's more data, there's more studies, that kind of thing. That being said, obviously, people got used to working from home over the pandemic. I'm biased on this issue. I've been working from home for 12 years. Absolutely love it. But the reality is, there's some bosses who are happy with it. So if you talk to the guys at say Atlassian, they think it's fantastic. But there is also another risk, Shari. There is also the risk that if you decide to work from home, what's to stop an employer saying, okay, well, I'm just going to employ someone in Asia to do your job because there's really no difference. So there is a bit more of a risk of outsourcing if people decide to go this way.
Yeah, all right. Leith van Onselen, Warren Hogan, thank you both so much.